Hello everyone, I hope you're doing well. So today's video will be about three statement modeling, and I'll be using a simple example of a hypothetical company which is an auto parts retailer. I believe this will give you a good perspective about how the financials of a company look like and how the three statements are interlinked. We'll also delve into the fixed assets schedule. So let's get started. So first of all, as you can see, we have the income statement, the balance sheet, the cash flow statement, and finally there's a schedule for the fixed assets or the plant property and equipment. So starting with the income statement, we have got everything from the revenue and then expenses, and at the end we have the net income to the common. So here you can see the revenue. So I've just added hypothetical numbers for the historical period. Cells that are in blue font are basically the hard coded numbers or the numbers that I have input. For the revenue, since this is an example of an auto parts retailer, so I am assuming that these are the units that the company has sold, and this is the corresponding price for each year for each unit. Basically, we can take it as an average unit price. If we multiply these two figures, we'll arrive at the revenue. So for this, we'll calculate the growth rate as to how the units sold have increased. So for this, I'll take a percentage change. This divided by the last figure less 1. So this is the growth rate, and I'll press Ctrl R to replicate the formula here as well. So as you can see, there is around 40% growth on the units sold side. So here I can just assume certain, let's say, growth rate for the future. I'll say in the starting first year in the projection, it's 25%, then let's say 15%, then I'll go to 10%, and maybe in the last year we can go till 6%. We'll just take the old figure and multiply it by 1 plus the growth rate. So here what we can do is we can add a round down formula. So what round down is going to do is it is going to give us a whole number instead of a fraction, comma. I'll just take till 1 digit, and then I can replicate the formula all the way till the end. So now we have projected the unit sold, and for the average unit price, I am going to assume that the price is going to be the same as the last year's price. So as you can see, we have kept the price as constant at $20. So now since we have got the figures for revenue, we can proceed with the revenue. So what we'll do here is units sold multiplied by the average unit price. Similarly, we can just select all these cells and press Ctrl R and replicate the formula in other cells. Now we have, if we see below, so we have got something called as a gross profit. So gross profit is profit we have generated after expending cost of goods sold. So cost of goods sold are the direct expenses that can be attributed to per unit of the goods sold. This as a percentage of revenue is called the gross profit margin. So I'm just going to take this. So as you can see, we have the gross profit margin of 54, 57 and 63%. So for the future years, let's say we take it at a constant rate of 65%. So I'm just assuming that the gross profit margin for the next 4 years is going to be 65%. So on the basis of this, what I can do is I can take the revenue figure and multiply it by the 65%. So in this way, I can calculate the gross profit margin. For the cost of goods sold now, I can subtract the gross profit from the revenue. And here I will get this figure. I'll just put a negative sign because it's an expense. So this is the cost of goods sold. And here I can also calculate the gross profit margin, which is 65% that we kept as a constant number. Now SG&A is basically the selling, general and administrative expenses. We can take SG&A as a percentage of revenue. So we'll just see what the percentage has been historically. I'll put a negative sign here just to bring the ratio as a positive number. As you can see, the number is kind of fluctuating so there is no specific trend that we can see. It's decreasing and then increasing. So in such cases, what we can do is we can take an average, and I'll just keep it as a constant number for the future. Similarly, for the other OPEX, I'll put a negative sign and take it as a percentage of the revenue. So here we can see there's an increasing number. Just to be on the conservative side, I'll take it as an 8%, a constant 8% for the projected period. Now since we have all these numbers, so we can project them. Here I can take a negative sign for the SG&A and I can multiply it by the revenue. So I get this number. Similarly for the OPEX, I'll take a negative sign and take this percentage and multiply it by the revenue. Now we can use the formula for the future years as well, and we can arrive at the EBITDA number. So this is going to be, or we can just take the formula from here. I can just press Ctrl R, and as you can see, we get the EBITDA number. So EBITDA is the earnings before tax, interest, depreciation and amortization. So D&A is basically depreciation and amortization, which is a non-cash charge. The cost is spread on the income statement throughout the life of the asset. We are going to calculate this number in the plant, property and equipment schedule, or the fixed assets schedule. So for this, maybe we can directly go to the EBIT number. We can just copy out the formula here, which is nothing but the EBITDA less the depreciation and amortization. Similarly for the interest expense, we'll come back to it later once we are done with the balance sheet and the cash flow statement. So meanwhile, we can just expand these formulae all across the future projections. And for the taxes, I've taken the effective tax rate as 25%. So effective tax rate is basically the tax as a percentage of the pre-tax income. So here you can see that this is multiplied by the pre-tax income. On the similar lines, we can just expand it to the future as well. And finally, we have the net income and the net income margin. So now we are left with these two, the D&A and the interest expenses. So here we can fix the formatting of the sheet a little. Here I can press Ctrl B and then Alt H FS to increase the size, let's say to 13. And for this I can press Ctrl B and Alt HH to change the color. Then I can press Alt H FC to change the color here of the font. So now it looks better. Also I can give it a little indent. So for that I can press Alt H6 and just I'll press Ctrl B across the important metrics, and so we're done here, and we can italicize these margins pressing Ctrl I. So I believe this looks better now. We can give it a little color here. So we're done with the income statement, and we're left with the D&A and the interest expenses. We'll come back to it later. Now let's go to the balance sheet. So I'll just quickly change the formatting of the sheet so that you don't have to go through all the process again. So here we're back with the formatted sheet. One more thing that we can do here is just to press Ctrl 1 and change this to custom. I can press inverted commas and type FY, and then I say YY. So as you can see, this is an easier format to read. I'll press Alt ES and then T for the format. Since this is a forecasted period, so I'll just again press control inverted comma and type E for the estimated, and I'll just press control C and alt EST for the format. So this looks better now. So for FY22 I have just added hypothetical numbers, and then we'll project the numbers from FY23. So for this you can see the asset side, we have the current assets and the non-current assets. Then we have the liabilities, current liabilities and the non-current liabilities. So basically current is something that will be either receivable or payable within a term of less than a year, and non-current is more than a year. Then we have got the equity. Then there is a convention that the assets must equal the liabilities plus equity. This can be thought of as analogous to how those assets have been financed. It can be either a mix of equity or debt. So from that point of view, you can say that the assets must equal the liabilities plus equity. And at the bottom, we have got some assumptions that we will use to forecast some of the numbers on the balance sheet. So for the current assets and current liabilities, generally we take these as a percentage of either the revenue or the cost of goods sold or the OPEX. So on the basis of these percentages, we can look at how the historical trends have been, and then we can move on and use those trends or averages for the future period. So for example, accounts receivable, we generally take revenues in the denominator. For the accounts payable, we take the cost of goods sold. And for the inventories as well, we take as a percentage of cost of goods sold. Then we have the deferred revenue. Here we generally take it as a percentage of revenue. Then the liabilities and the other assets. So for these, we can take the OPEX and revenue in the denominator. So just quickly going through all these. So here I've taken revenue, cost of goods sold and OPEX. I've linked this to the income statement here so that it is easy to compute all these ratios on the same sheet. So for example, this is accounts receivable taken from this cell, and then I have taken it as a percentage of revenue. So here we have got the values. So for the future period, I'm just assuming that it is going to be same as the previous number. But if we have more data for the historical period, here we can then take some assumptions on the basis of the trends that it has been following. But here I'm going to assume that it is the same as the last period. So all the way till this. And similarly for the others, I'm going to assume that this is the same number for the future period. So I'm just gonna copy these numbers. So now we can forecast this. So for this, I'll extrapolate the income statement numbers all the way till the end. So we have already calculated these in the previous sheet. So here for the accounts receivable, what we can do is we'll go to the accounts receivable percentage revenue and we'll multiply it by the revenue. And then you can press Ctrl R. Similarly for the inventory, I can just take the cost of goods sold multiplied by the inventory number here. So as you can see, we can extrapolate this number, and we can also take the total current assets, which is nothing but the summation of the cash, accounts receivable and inventory. So here we have got all these values. So cash will be linked at the end. Once we're done with everything, then we'll link the cash at the end on the cash flow statement. So there are certain items that we will link later once we are done with the cash flow statement. So after this, we'll go to the other non-current assets. So here we can just see the other non-current assets. So these as a percentage of revenue. So we'll multiply this by the revenue. Then we have got the Okay, so this is a summation. Okay. So I've just taken the sum here for the total assets. So ORTST for the format. Okay, so we are done with other non-current assets as well. Now the accounts payable. So for this, I'll just take this as a percentage of. So I'll multiply this by the cost of goods sold. And for the deferred revenue, I will multiply revenue by this number, deferred revenue percentage revenue. So I'll just fix the formatting by pressing Ctrl C and Alt S, then pressing T for the format. So now for the other current liabilities, I'll go to the OPEX and then multiply it by this number. Just to quickly format, I'll press Ctrl C and Alt S T here and then Ctrl R. If you would like to learn Excel in terms of the keyboard shortcuts, I have also made another video where I have comprehensively explained a lot of keyboard shortcuts. I will drop a link in the description. So for the other non-current liabilities, I can just take the OPEX and then multiply it by this number. So I'll fix the formatting. Okay, so this is all right. For the equity, I'm going to wait until I'm finished with the cash flow statement because we're going to link the equity to the cash flow statement later on. So now we are left with some of the items, that is the cash, the net property, plant and equipment, then we have the long-term debt, and then we have the equity. So for the long-term debt, we have made some simple assumptions here. Basically, this is the financing that the company will be requiring in the future periods. On the basis of the complexity, we can also go for a debt schedule. For the common equity, I'm assuming that there is no issuance in the future periods. Similarly, for the preferred equity, there is not going to be any issuances in the future. So payout ratio is the dividends as a percentage of the net income. But for the sake of simplicity, I'm just going to assume that the company is not going to pay any dividends. So I'll take it as 0%. And the dividends then are going to be the multiplication of the payout ratio in the net income. So here in the income statement, I will link it to the net income from 2023. So here we are assuming that there is not going to be any payout ratio. I've just modeled it in order to show you how you can take it into consideration. So for the interest rate, what we can do here is we can just look at what interest the company has been paying on its debt, although it's generally the market value of the debt that we take. But here I'm just going to assume the book value of debt. So for this, we're just going to go back to the income statement and see what expense in terms of the interest cost the company has paid. So I'll put a negative sign and link it here on the interest expense. And then I'll take it as a percentage of the debt here, which is this number. So if I divide it, we can see it's around 11%. So for the future, I can just assume the number on the basis of this. Although again, we can model the interest rates on the basis of the benchmark and the spreads into the future. But again, for the simplicity, I'm just assuming a couple of numbers here. Let's say these are the numbers that I'm assuming for the future. So here we are mostly done. And finally, here is a check that we generally add to the balance sheet. So for this, I'm just going to say that if, so just remember the thing that I told, that the assets are equal to the liabilities plus equity. So that condition needs to be fulfilled here. So what we can do is we will say if round, I'm using a round because it may happen that the figures are not exactly same, but maybe there's a point difference. So just to eliminate that thing, I'm using the round function here. So round this is equal to this, the total assets, and for the round I'm using 1 digit. Then I'll close the bracket. So this is a logical test. So after this, so if the value is true, so if it is true, basically the total assets are equal to the liabilities plus equity. So in that case, I'm gonna say inverted comma okay. Otherwise, I'm gonna say inverted comma check, and I'll close the bracket. So here, as you can see, it is saying okay, and I'll go to the, and then I'll just replicate the formula. So as you can see here, it's not matching, so it's saying check, but it will be okay after some time. So now we're done with the balance sheet. So now I'll just go to the plant property and equipment schedule, and we'll forecast the depreciation. So here I'll just format the sheet and come back. Alright, so we are back. So here you can see I have added some capital expenditure, whatever the company requires in terms of expanding its business. Here the depreciation is going to be in two parts. One depreciation is going to be for the current assets that we have, or the current long-term assets, or basically the fixed assets. And then there is going to be a depreciation for the capex that the company is going to spend on in the future. So for current PP&E, for that I have kept a fixed value. So let's say it's negative 90 for all the future periods. Now for the depreciation for the new capex, depreciation for the future capex. So here I can just take all these values. I'll say Control C, and I'll press Alt S V, and I'll press the transpose here. We can use the nested if statements here. So there's going to be condition, right? So I'm using the straight line depreciation method, which is going to be same for all the periods. So for this we'll say if this date is less than this date. So if this date is less than this date, then there is going to be a depreciation expense, a full depreciation expense basically, which will be equal to the capital expenditure divided by the useful life of the asset. So this is a straight line depreciation method that I'm using. And if so here, if this is not the condition, I'm using an if statement again. If this is equal to this state, there is not going to be a full depreciation expense. So for this case, we're going to take the depreciation divided by 2. And let's say if none of this is the case, if it is neither less than this state nor is it equal to this state, so it means that it is greater than this state, right? So if it is greater, it means we have not purchased it yet, so there is not going to be any depreciation expense. Then we'll just simply put a 0, and then I'll close the bracket twice, and I'll say now I'm just going to fix some references. For example, this date needs to be fixed in terms of the column, and this date is going should be fixed in terms of the row. So we can press the F4 function here to fix the rows. To fix the references, we can use the F4 function to fix the references. And for this D3, we can just fix it all across. And for this, we are also going to fix the references for both the rows and the columns. So this is going to be same as the one we did earlier. Same for this. And here we'll just fix the whole references. So we'll just press Ctrl R for this, and we can see how this moves, right? And then we can also just copy and paste it, but here we'll need to change the reference for this D3 cell. Basically this needs to move to this cell. So here I'm just gonna change this D to E, and here also I'll change just to this, and then I'll go with this formula. Again, here I can just change this E to F, again this E to F, then I'll press Ctrl R, and finally we have got the last one. So for this I'll go with the G here, and again the G here. So as you can see, this is how the depreciation expense is gonna look like. See, the first year in the projection period, since the capex is 0, so there is no capex, so there is no depreciation expense for the future period, right? In the second there is, so it will start from this year, and it is going to be half depreciation expense, right? Because it is equal to this date. And for the future period, since this date is less than the date here, so it's going to be a full expense. Similarly, third year there is no expense, and the fourth year it is going to be a half depreciation expense, right? So this is how we are going to model the depreciation expense, and we'll type here total depreciation, and I'm just gonna take a sum of all these. So now we'll say this opening PP&E balance. So this is going to be the, we'll take from the balance sheet, we'll go to the net PP&E. So basically this was the closing balance for the last year, and this will be the opening balance for this year, right? So for this projected period, this will be the opening balance. For the capex, we're going to take the capex from here, and this will be a negative sign because capex will be an addition to the plant, property and equipment. And then for the depreciation, we're going to take this plus this expense, and then the closing balance is going to be the summation of all this. So for the opening balance here, now I can link it to the closing balance, and this I can press Ctrl R again, and now as you can see, this is the closing balance for all the years that I have got. I will just press Ctrl B. Now moving on to the cash flow statement, I'll just do the formatting again, and then I'll come back. Alright, I'm back after the formatting. So now the cash flow statement, it is comprised of the three sections. Basically, there is the cash flow from operations, then we have the cash flow from investing, and then we have the cash flow from financing. Then in the end, we have the net change in cash, and then we have the closing cash basically at the end. So it starts with the net income. For this, I'm going to go to the income statement and link the net income here. Now, since this is a cash flow statement, so we'll have to add back any non-cash charges that were on the income statement. So for this, I'm going to press a negative sign here and go to the income statement. So here I can just link the depreciation and amortization expense here. Basically, this is going to be the summation of this and this. So here we can get the expense, right? Now there is this section called the change in working capital. So for the change in working capital, I've also prepared a comprehensive video on the working capital analysis. You can go and watch. I'll also drop a link in the description. But just to give you an overview, let's say this is the inventory. Let's say this is FY20 and this is FY21. Let's say in the last period the inventory was 0 and now it's 100. So the change in inventory, when we talk about the change in inventory, so that is going to be 0 less 100. Just think of it from the cash point of view. In order to increase my inventory from 0 to 100, I'll have to expend $100, right? So that will be depicted by a negative sign. So when we talk about the assets, the change in assets, that is going to be the previous period less the current period. And when we talk about the liabilities, they're going to be the current period less the previous period. So for example, here for the accounts receivable change, I'll go to the income statement, I'll go to the balance sheet, and then I'll click on the previous period balance, accounts receivable, and less the current year. So this is depicted by a -88. Similarly for the accounts payable, I'll go to the current balance less the previous balance. Similarly for the inventory, I'll go to the previous balance less the current balance. For the other liabilities, the current less the previous. For the deferred revenue, again the current less the previous. And then we have the change in other assets and liabilities. So for this, we'll take the other assets for the previous period. Less the current period plus. For the liabilities, I'm going to take the current period less the, this is the current period less the previous period. So this is how we take the change. And then we have the total working capital changes. We'll just take the sum. And then you have the cash flow from operations, which is nothing but the net income plus the non-cash charges and the change in working capital. So this is going to be the cash flow from operations. Now we can just take this and press Ctrl R for all the values, and we get the cash flow from operations here. So for the cash flow from investing, I am taking only the capital expenditures here. And for this, I'll just link it to the schedule here that we have planned. So this is the planned capital expenditure for the future. And this is just the sum. We get the cash flow from investing. I'll just press Ctrl B. Now for the cash flow from financing, this is going to be the sources of funding. It can be debt, it can be equity. So just for the debt drawdown, we have the values here in the balance sheet. So I'm just going to add these values here. For the equity issuances, we are assuming 0, and for the preferred equity as well, I'm assuming it as 0. And for the dividend, since we assume that there is 0 payout ratio, 0%, so the dividends paid are again 0. So the cash flow from financing will be the summation of all this, and I'll just press Ctrl B again. So the net change in cash is nothing but the summation of the cash flow from operations, then cash flow from investing, and the cash flow from financing. Again, I'll press Ctrl B. So for the opening cash balance, I'll just go back to the balance sheet and take the ending balance of FY22. For the excess cash generated, I'll click on the net change in cash, and then finally with the closing balance, which is nothing but the summation of these two. And here the opening balance is going to be the closing balance here. So we can press Ctrl R and we get the closing cash balance. So you can press Alt H, B and C. So now I'll go to the balance sheet and I'll link the pending items here. For example, for the net PP&E, I'll just take the previous balance and then I'll press negative, and I'll go back to the cash flow statement. So I'll link the depreciation amortization, then I'll press a negative again, and I'll link it with the capital expenditure. I'll press enter. So this is my closing net PP&E. Then with the long-term debt, so for this I'll go to the previous balance and I'll add. So here I can link it to the debt drawdown, and then there is no other item that we need to link it to, so I'll just press enter. So this is the debt balance that we have. For the equity, I'll take the old balance and then I'll add the net income. After this, I'll add the equity issuances, the preferred equity issuances, the dividends, and then we have the cash. Before this, we'll link the interest expenses here. So for this, I'll go back to the balance sheet, and we have the interest rate here. I'll just multiply it by the debt, and I'll add a negative sign in front. to depict an expense, and here we can just replicate the formula all the way till the end. Now finally we have the cash. So for this I can link it to this. So now we have linked all the items, and if we go down here you can see the check is complete. We have got a balance sheet correct, so everything is in line, everything has been linked properly to the cash flow statement. So this is something that has to be taken care of, that this check must be okay, or basically this must always be in line with the equation that assets are equal to the liabilities and equity. So now as you can see, starting with the income statement, we have all the items from the revenue till the net income, and for the balance sheet we have linked everything, and then on the cash flow statement also we have added all the line items with the C cash flow from operations, investing and financing, and then finally we had this plant, property and equipment schedule. So I hope after watching this video you have got a good perspective about how the financials of a business look like on the three financial statements and how the three financial statements are interlinked. I hope you enjoyed watching this video. If you like it, please subscribe to the channel. I will see you the next time. Thank you.